Global markets are currently navigating a period of heightened geopolitical uncertainty following the escalation involving the United States, Israel, and Iran. Rising tensions around the Strait of Hormuz, a critical global energy choke point, have pushed Brent crude prices from around $70 to $75 per barrel to above $100, briefly touching $115, while LNG prices have also surged amid supply disruptions. Elevated energy prices are inherently inflationary, increasing transportation, manufacturing, and utility costs worldwide. For India, persistently high crude prices pose risks through higher inflation, a wider current account deficit, and pressure on the rupee. Currency weakness could further amplify imported inflation and keep long-term bond yields biased upward. A $10 increase in crude oil price sustained for a year may hurt GDP growth by approximately 0.2%, increase inflation by approximately 0.2% and widen the CAD by approximately 0.3%. However, India enters this phase in a relatively stronger position compared with previous oil shocks, supported by robust foreign exchange reserves, lower oil intensity of GDP, and improved macroeconomic stability. From 2009, our oil import bills have grown approximately 1.8x while GDP has grown approximately 3.1x. Forex reserves have almost trebled from $255 billion plus to approximately $725 billion plus. Geopolitical tensions have also triggered risk-off sentiment across equity markets, resulting in a broad correction. While the decline at the index level appears relatively moderate, the correction across individual stocks has been significantly sharper, similar to the phase seen in March 2025 that was followed by a healthy rebound. Almost 74% of the Nifty 500 stocks are trading below 200 DMA and the average stock level correction in mid and small cap is approximately 24% and approximately 30%, respectively. Markets have undergone both time and price correction over recent months, bringing valuations closer to historical averages. The Nifty 50 is currently trading below its 10-year average on a 1-year forward PE basis, while valuation premiums in the mid and small cap segments have moderated considerably. At the same time, corporate earnings are showing encouraging signs of recovery. Nifty 500 companies reported the strongest profit growth in the last 8 quarters, with nearly half of the companies delivering profit growth above 15%. The recovery is becoming increasingly broad-based across sectors and is expected to remain supported by structural drivers such as GST rationalization, income tax cuts, potential monetary easing, trade agreements, and a supportive regulatory environment. Market volatility indicators suggest that a large part of the geopolitical risk may already be reflected in prices. India's volatility index levels are broadly comparable to those seen during recent major events such as the Russia-Ukraine conflict, the 2024 union elections, and the tariff-driven volatility in April 2025. Technically, the Nifty 50 daily RSI has fallen below 30, indicating oversold conditions. Historically, geopolitical events tend to create temporary disruptions rather than long-term structural changes in markets, often presenting opportunities for disciplined investors. Out of the 27 years, the Nifty 50 index has ended the year positively in 22 years, that is 81% of the time, despite an average intra-year drawdown of 19%. The temperature gauge remained in the fair zone but has moved much closer to the attractive zone. In this context, the current environment can be viewed as a tempest, a period of heightened volatility that, while unsettling in the near term, is typically temporary. Rather than retreating, investors should approach this phase with discipline, patience, and a structured allocation strategy. Our overall equity stance remains neutral, with a recommended portfolio allocation of 50% to hybrid or large caps, 10% to global equities, and 40% to mid and small caps. From an implementation perspective, lump sum investments may be considered in hybrid funds at current levels to participate in the bounce if it happens while keeping the downside in check. Pure equity allocation should ideally be staggered over the next 2 to 3 months, given the prevailing uncertainty. Any sharp market correction should be viewed as opportunities for more aggressive deployment. US yields rose more sharply as the market pushed back Fed rate cut expectations. Indian yields stayed better supported despite the oil shock and global bond sell-off. A key support was RBI secondary market buying, in addition to the announced 67,000 crore INR OMO auctions. India rate cuts are now less likely in the near term, as higher crude raises inflation and external balance risks, prompting a more cautious RBI stance. Within fixed income, the risk of elevated crude prices translating into higher inflation, currency depreciation, and a wider current account deficit could keep bond yields under upward pressure. Against this backdrop, accrual strategies across the credit spectrum remain the preferred core approach, along with income-generating assets like infrastructure investment trust. On gold, rising oil prices have pushed investors towards the US dollar and energy assets, leading to short-term profit-taking in precious metals. However, the recent correction does not necessarily indicate a structural change in the outlook for gold. Central bank buying continues along with the demand from the exchange-traded fund. With the geopolitical uncertainty becoming a norm rather than a one-off event, the importance of gold in the portfolio allocation has become more pronounced. Moreover, gold remains a strategic portfolio asset amid ongoing fiscal imbalances, currency debasement, and an uncertain monetary policy outlook. Any correction should be considered as a buying opportunity to have allocation in line with the asset allocation mandate.